Hey, Nate Caldwell here with another mortgage market update. Interest rates, 30-year fixed right now about 6.87%, down about a tenth of a percent since last week. As we've talked about many times, mortgage rates track inflation. Both CPI and PPI are dropping, but mortgage rates have been stubbornly high now for the last few months. The reason for that is banks are feeling a crunch with what the Fed is doing as they continue to raise interest rates. Banks primarily function or are profitable when they have depositors depositing more money into their checking savings accounts that they can then lend out at a higher rate of interest. People are not depositing money into checking savings accounts, so the banks are running into a liquidity crisis. When they have liquidity crises, they sell their assets, which in this case are mortgage-backed securities or treasury bonds, to shore up deposits. As they sell these bonds, that drives the price of these bonds lower, which in turn drives rates higher. Take out what's happening in the banking sector, we'd probably see mortgage rates in the lower 6% range. The good news is some of these tactics the banks are taking right now to shore up their balance sheets have pretty much run their course, meaning that they now understand that in the environment they're in, they're doing some things called mark to market that has worked through the system. And coupling that with inflation on the way down, we should start to see rates slowly decrease over the next few months. I think it's also important to understand what is happening on the supply side with real estate. New residential home construction is on an annualized basis going to increase 1.6 million units. But unfortunately, household formations are outpacing that growth. And what that means is that demand for real estate is going to increase. And as much as you may hear the naysayers that think that values are going to start decreasing because of the elevated interest rate environment, the most basic economic supply and demand curve is showing that is not going to be the case. We're going to see values continue to rise, probably not the astronomical 20% that we saw over the last couple of years, but we will see values increase. I'm hearing more and more folks say, hey, I'm going to wait for rates to drop before I look to purchase. What you're not understanding is that if the value increased 5% in that same period of time, it's going to be more costly versus purchasing now and then refinancing down the road. If that's helpful, any questions you have, you know how to reach me.